this week's edition of Navigate Your Wealth, brought to you by Compass Financial and, of course, the power team behind Compass Financial, Karen Stewicki and Samantha Irish. Great to see you.
Good to be back. I love that color on you, Rebecca.
Thank you. I'm starting to, looking forward to Christmas, I guess, a little early. So a lot of people who write in, kind of getting a fan base now, a lot of them are really fascinated when you touch on life insurance. It honestly does seem too good to be true. When you say you can get a policy, it'll give you income, it'll be non-taxed. So let's really delve into that if you don't mind.
I think we want to start with just what is it, right? The life insurance industry over the years, I don't think has done the best job of branding themselves.
Terrible. Yeah, I agree.
I think most people, when they think of life insurance,
they need to pay y'all because you do a better job of promoting them than they do.
Well, when I introduce myself to people and I say, oh, I sell life insurance, they're like, thank you very much. They are the first ones out the door.
You're pretty, but no.
And I just think that the industry has gotten a bad reputation, but life insurance is an incredible solution and an incredible resource for so many individuals. In fact, we've said it before, you firmly believe this, that every single person needs to have life insurance.
It really needs to be in the foundation of everybody's plan, because life insurance is what ignites the power of everything else that you have.
Wow.
It is not a disabler, it is an enabler. It really is. And there's different types of life insurance, so we want to just kind of cover so that everybody kind of gets an idea.
Yeah, when you say ignites everything else, explain.
I'm going to explain that when I tell the story that episode or so ago, Samantha said, tell the story, and I'm like, we got one minute left. There's no way I can tell that story. But I promise you're going to hear the story, because it really talks about the power of what life insurance can do.
But I want to go back and actually talk about what the different types are. Think about this. When you get a car, you are required by law to get car insurance. When you purchase a home, you are required to have homeowners insurance.
Yes.
When you have a life, you are not required to have life insurance. Although it's the only thing that's guaranteed to expire.
That's right.
I mean, I hate to say it that way.
Yeah, you might not get in a wreck. Your house might not have a fire, but you're guaranteed.
There is a 1 in 1 chance that we are going to die. So why is it that we're not doing a better job of educating individuals to say, this is the one thing I might actually get to cash in on?
Well, and Sam, let me jump in for a second, because, you're talking about the car. Is there going to be a car wreck? Is there going to be a home fire, right? If you had a $100,000 income, I'm going to ask you a question a different way. If you had $100,000, or if you had a machine in the basement that kicked out $100,000 a year, every year, would you insure that machine?
Yes.
Yes. You are that machine.
Oh, y'all are so cute. Okay.
Yes, you're that machine. So, the interesting thing is, I told you in, again, a previous episode that when I was originally in the securities industry and New York Life came to me and said, you should sell life insurance, I said, you are out of your mind.
Yeah, not interested.
And I spent the first year trying to prove that life insurance was smoke and mirrors, that the only people that got rich was the life insurance industry. Because let's face it, I'm going to pay a premium and have to die for somebody else to benefit.
Right.
That is how a lot of people think about life insurance. What if you didn't have to die? What if we could show you a way to use the living benefits in a life insurance policy and not have to die? Now, when I said you have to pay a premium and die for somebody to benefit, that is a term policy. And as Samantha said last episode, listen, nobody's going to ask at the funeral, what kind of life insurance did they have? They're only going to make sure your family's going to be okay.
Right.
So first and foremost, we want the protection component to be there. But permanent life insurance, cash value life insurance, has so many more benefits.
Cash value.
Cash value life insurance.
So term is just, you're
renting.
Yeah, and think about it this way. Term is really for a period of time, a term of time. So it's usually a low-cost solution to cover a period of time where you may have an extra need. I mean, when you purchase a home, they want to make sure if something happens to you that can be covered. So you typically, in most cases, unless you have a permanent policy, look for a term policy to be able to cover whatever
20-year, 30-year period of time.
If you die, to cover the rest for your family.
That's right, to pay off that mortgage.
But you can't take money out of the term. That is only like a death.
No. Think of it
Should be called death insurance.
Well, it's I hate to call it that, but I want you to think of it this way.
Okay.
When you first get out of school and you go to look for a home, you're usually looking to rent. And all the time that you're making that payment to the landlord, you have a roof over your head,
right?
But you're not building any equity.
But he is.
The landlord is.
Right.
Term insurance is the landlord. The insurance company is the landlord. They're giving you the protection. If you die, they are paying that death benefit.
Right.
But if you don't die, that money is gone. You're never seeing it again. Permanent insurance, cash value, is where part of it goes to the cost of insurance, part of it goes to building up cash. It's like the equity in your home. When you finally go to make a home purchase, you now have a mortgage, and just like a mortgage, on the front end, most of it's going to the mortgage company.
But your partner is the bank.
But your partner is the bank. On the life insurance, the first initial premiums, a lot of it's going to the cost of insurance and the acquisition of doing the underwriting and all of that. But over time, you're building cash in that policy just as you're building equity in your home.
So how does it work? I mean, how does it benefit the insurance companies? If we are able to take that cash, how are they making money?
It's kind of threefold when you look at how that works. The first is, as we talked about, term insurance, right? You're giving your money away. Most people have term insurance for a short period of time. So they get it in their 30s, they maybe buy a 20-year term or a 30-year term, and then when they get to an age that we consider you eligible to die, so right, you're in your 60s, the term insurance is so expensive, you cancel it.
Well, and I want to throw in a fun fact here, Rebecca, because you say, how does the insurance company make money? Did you know that this is an actual statistic, that less than 2% of term policies actually result in a death claim? Now, I want to say that again.
Wow.
That means that 98% of the policies that the insurance company wrote are going to be canceled or maybe converted to a permanent policy, because that's something else you can do with it. But they're going to mostly be canceled before they die. So think about it. If you are the insurance company and you know that you're getting the premium month after month after month after month after month after
investing.
Cha-chink, 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 because they know that there's only a 2% chance that they're going to have to pay that death benefit.
So let's say I bought one at 35 and I'm paying $90 a month, which is actually true. And you're saying when I'm 60, or whatever, they're going to raise the rate? It wasn't fixed. I've been paying $90 every month
if you have
for 20 years.
Yeah. If you have a level payment, so if you have a increasing every year, the policy premium will go up. If you go 10-year or 20-year or 30-year,
it stays the same.
Here's how they get the premium, though. They figure out what the increase in cost would be for 30 years. They add it up, they divide by 30, and that's what you pay now. So think about it. You could be paying this premium now and this premium later, but instead they say, nope, you're going to pay this premium for the whole time. You're paying way more now than you need to. So if you know you're dying soon, don't go with a 30-year term, because you're overpaying in the first 10 years. Yeah.
Okay, well, I need y'all to look at that for me. Let me write myself a note on that one.
So, and then when you get to 30 years, the reason that it increases is because they want to be able to give you the protection that you probably still need.
Or they want you not to
they're going to have a cost. Exactly.
Yeah, they're going to price you out of it.
They're going to price you out of it. Look, life insurance is an individual situation. Whether you need term or you need permanent, we want to have that conversation with our viewers, with our clients, so that it is personalized to your needs. Pick up the phone now and call the number on your screen, 855-348-3073. We want to make sure you have the protection, but if there's a way to leverage it, we want to do that for you too.
Absolutely. Getting cash every month from an insurance policy is fantastic. We're going to continue that conversation with Compass Financial right after this.